I absolutely agree with you, Mario. I think anybody who's thinking of getting into either the physical metals or the mining stocks, they should hurry up because
Yeah,
it won't be too late in a month's time, but the prices will be higher, probably.
yeah.
And that's not investment advice, it's my opinion.
I think the futures market is really on COMX. It's not really a physical market. It's a paper market, but I think that's a problem. And we could see the futures market lead the markets higher. And apparently, Clive, as well, on Friday, it looks like open interest in silver went down, which is really in the silver futures, which is unusual because the market was going up. So the reason open interest went down is that people were covering their shorts.
Precious metals markets are showing signs of a decisive breakout, and this time the dynamics appear to be different. Gold has pushed through long-established resistance on daily, weekly, and even monthly closes, while silver is approaching levels not seen since 2011. Add in unusual activity in the futures market, with open interest falling even as prices rise, suggesting short covering and a potential squeeze, and the setup looks more like the beginning of a structural move than a fleeting rally. Clive Thompson and MarioInnecco delve into the technical and fundamental signals indicating a path toward higher ground. They highlight the resilience of mining shares, which in past cycles collapsed at multiples of the metal's declines, but now seem to be holding firm, in some cases even rising as gold dips. That resilience may be a sign that institutional money is already shifting allocations, with the GDX to Nasdaq ratio beginning to break out in favor of miners. Whether it's the 50-year cup and handle in silver or the sharp sideways compression in gold finally giving way, the signs are aligning. For investors, this could be the moment where patience pays off. Before we dive in, please hit the like button, subscribe if you haven't already, and turn on notifications so you never miss critical insights like these. We appreciate the support and hope you enjoy the video.
So this is a chart a lot of people have been looking at, because we had been consolidating since April in gold, and now it's finally broken out of this triangle. It tried here like a few weeks ago, and it failed. But this is really definitively broken out. And this is the highest closing on a weekly, daily, I think, as well, and monthly basis for gold. So it's pretty significant. You never
Actually,
know with gold, though, do you, precious metal? But I think this time around it could be for real, the continuation.
I sent you a rather colourful chart a few hours ago, Mario. Perhaps you didn't see it, which was basically it's interesting. You've drawn exactly almost the same thing
Yeah, it's the same
as
chart.
mine.
Yeah, and there's another one here. I think this is the same. This is gold, but it's monthly, and this one seems to have broken out as well. The monthly chart.
And you'll see if you look at the silver chart, it's also breaking out.
Yeah, that's the silver. This is monthly, so 2011. I think silver is only closed here on a monthly basis, like there's only 2 to 3 other months in the past forever that silver's closed here. So this is very encouraging as well.
It really feels like we're in the middle of a breakout point. I mean, we've had a sideways movement for gold and silver now for since last May.
Yeah,
It's been up and down, but it's been literally it's been sideways. And suddenly on 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 Friday, well, I'm not
yeah,
sure yet, but it looks like we're breaking out. And if you look at Pax Gold, which is the one which trades 24 hours a day, 7 days a week, 365 days a year,
yeah.
it's about $30 as I speak.
Let's see, PAX.
Yeah, that's a crypto. It's obviously it's exchangeable into gold one for one.
Yeah, well, it says 3464. So,
You're looking at there's several versions of it. You look on the different exchanges. Let me just bring one
which
up.
one are you looking at? PAX Silver
Uh,
or?
Pax Gold. I don't think it was a Pax Silver.
Well, I
Um,
think gold
Let me just
closed
bring
at
it up.
3450 or
Yeah,
thereabouts
that's
on
right.
Friday.
Yeah,
So it looks like it's about up about 15 bucks. But Pax Gold, I don't think is a great indication of where gold
No,
is going.
it usually trades when gold is open, it trades very, very close to
Yeah.
the gold price.
And this is
I,
Clive, this is a chart of silver going back to the 70s.
yeah, I've got 34.81 for Pax Gold on my
Oh,
screen.
okay. I think this is the famous teacup and handle for silver, and the teacup formation. I first heard of it back in like '04. There's a big teacup in gold from the mid 90s to 2003, and Jim Sinclair said, "Oh, this is really bullish." And yeah, it was. We broke $430, and gold went almost straight up to like 600, 700, eventually went to 1,000. But this teacup has been forming for like, I mean, almost 50, well, more than 50 years, or yeah, 45 years. And I think what it says is that there's a huge pressure. It's like a pressure cooker almost, and when it blows through the top of the teacup, and we've blown through the handle already, it could get really explosive, silver. I think that's why the silver miners as well, I think, are even more interesting than the gold miners, even though I have both.
I absolutely agree with you, Mario. I think anybody who's thinking of getting into either the physical metals or the mining stocks, they should hurry up because
Yeah.
it won't be too late in a month's time, but the prices will be higher, probably.
Yeah.
And that's not investment advice, it's my opinion.
Silver futures are just like a silver, but on the futures market. But what I've read, and I listened to an interview on King World News, I think is Egon von Greyerz, and I think there are other analysts out there saying that it's really hard to get physical silver right now. I think Egon von Greyerz said he can't source physical silver for his clients in Switzerland, and they are big clients, Clive, not small retail. And I got an email from a dealer in the UK the other day offering to pay 6% over spot for most of the one ounce bullion silver coins. So that to me means that he can't source the silver. So I think the futures market is really on COMX. It's not really a physical market. It's a paper market, but I think that's a problem. And we could see the futures market lead the markets higher. And apparently, Clive, as well, on Friday, it looks like open interest in silver went down, which is really in the silver futures, which is unusual because the market was going up. So the reason open interest went down is that people were covering their shorts. So it looks like there's a short squeeze. And it could, so the silver market could be driven by the futures market. And this is the GDX to Nasdaq 100 ratio. And yeah, this looks quite like quite a sharp breakout. I think I've taken out the years underneath here. So
So what we can see here, Mario, is that at least in the last month, and I did say August was the month.
yeah.
In August, we've seen more people, or I won't say more people, but we've seen more upwards movement in the gold miners than we've seen in Nasdaq. So the balance of where the money's going is shifting.
Yeah, and the other thing, Clive, like you said earlier, I think, and I've been noticing because I've been following this for years, and in the past, every time gold and silver got hit quite hard, the miners would go down 4 or 5 times, in terms of percentage. And recently, they hardly ever budged. If anything, sometimes they went up.
Well, that last month was a classic case. Gold
Yeah.
would go down some days, and the miners still went up.
Gold and silver markets are reaching a decisive inflection point. Behind the daily headlines, deeper forces are at work. Delivery demands on COMX in 2025 are already exceeding those of all of 2024, signaling that large, well-capitalized players are quietly removing metal from the system. These aren't small retail trades. They are 100-ounce bars, worth hundreds of thousands of dollars each, being transferred into the hands of those who clearly see what's coming. At the same time, mining shares are beginning to outperform bullion itself, something rarely seen in the past decade. Even on days when gold dipped, miners have rallied, showing that institutional capital is rotating into the sector ahead of what could be a significant breakout. Combined with the structural vulnerabilities in the U.S. Treasury market and the possibility of a Nasdaq pause, the setup for precious metals has rarely been this compelling. Let's get back to the interview.
I think the precious metals go vertical will be the day that people start to there's a wobble in either the U.S. Treasury market, but it could be also the UK gilt market. We've had that Liz Truss moment a few years ago, and it's going to come back again, I think, in the UK, and I think we're just on the cusp of it happening in the United States. So, I think two things. One, if we have a wobble in the Treasury market, even though higher yields normally would be bad for gold, I think this time around it'll be good for gold because people will be pulling out of the treasuries looking for somewhere safer to go, and they will go to gold. And the other thing which I think would be turn gold, but more slowly vertical, but it will still be going vertical, is if we have a long pause in the bull market on Nasdaq, well, we've still got this wall of money going to Nasdaq, and the prices at Nasdaq and tech stocks and the US S&P 500 in general. But if that starts to pause, and we don't know, on Friday it was down a bit, so who knows? But if it starts to pause and it stays in pause for maybe a few months, I don't know, 2 months, 6 months, then people are going to start pulling the money out of that index and looking for other things to buy. And I think gold will be the place they'll be going. So what you're looking at is the amount of gold which has been called for delivery this year in 2025 is significantly higher than the amount of gold which has been called for delivery in 2024. That's the figures on the left-hand side of the sheet.
Yeah.
So you see the two columns. So these are 100-ounce bars. We're talking about $350,000 a bar, roughly. So it's not mom and pop saying, I'll buy a trinket of gold here or there. This is some big buyers. We don't know who it is, but whoever it is, they bought more bars up until the end of August and the beginning of September, the first day of September, which hasn't even started yet, but they've been called for delivery. They bought more bars of gold than the whole of last year, or when I say bought, they've taken delivery of it. And this is unusual. So these bars are going into the hands of somebody or some firm who's very, very wealthy, must be very well connected, must be very knowledgeable. They have access to the greatest economic information on the planet. And we don't have to know what they know, but they certainly know something. And if you have any sense, you'll follow the money.
Well, there was, sorry, Clive, there is one thing I need to say about the COMX terminology is that taking delivery actually doesn't mean that you take the silver out of the COMX vaults. That happens when you withdraw the silver, and that will be a lot more serious. And that's something we need to keep an eye on because when you take delivery, let's say account A or counterparty A takes delivery, it comes from counterparty B, but the silver stays in the COMEX vaults. There is no like withdrawal from the vault. Withdrawal is really important as well. But I agree with you that I mean, look at May, almost 10 times more. And the same thing for silver, not as much for silver.
Well, what's interesting is September silver, which is, they've just called that or the first people are calling for delivery for the 1st of September. There's more calling for delivery of their silver bars on the 1st of September than the whole of September 2024.
Yeah, that's right. 8,286. And September, I mean, September is still just beginning. Is just going to begin.
It starts tomorrow. So
this
is the deliveries for the first of
second, I guess, because
second, I guess,
holiday.
Second, yes.
But that's just for one day. It could turn out to be 25,000. I don't know.
So what you do, you take the gold price or the silver price that you expect to be in the future. Let's say you're going for $100 silver or $50 silver or $100, 4,000 gold. You take the price you expect the metal to be in the future, deduct from that the all-in sustaining cost that you think that will be incurred in 3 or 4 years' time. So you have to add some inflation. That the net result, you multiply the net result by the number of ounces of gold or silver that you're going to get out of the ground in 4 or 5 years' time.
And that's the
That
earnings for the.
that's their gross earnings. You deduct from the gross earnings their other expenses. That's the taxation, prospecting, and things like
Interest
that. All the other expenses
payment.
they got.
Yeah.
And then you've got the net earnings. Then you divide the net earnings by the number of shares they've got, and then you get the earnings per share. And now you take the earnings per share and you multiply it by whatever you think the price earnings ratio will be
Oh, all
in
right.
that future year. Let's say you think it's going to be 10, you multiply by 10. If you think it's going to be 25, you multiply by 25, and you get to your future share price. I think you can see, can you see the spreadsheet at the moment?
Yeah.
So at the top where my mouse is, I've got a price of $50 here,
Yeah.
and it tells me the my targets of where these will get to. It's called the best estimate of possible share price in 27, 28, based
Mm.
on a $50 target. But if I change the target to $100, you'll see the target prices of everything changes, just
Yeah.
changed there. So looking down the top 5 or 6, you can see they're broadly speaking going to give you 1,000% profit if
Wow.
we get to $100 gold.
Oh my
That's
goodness. Yeah.
and by the way, I'm being very conservative here, Mario,
Yeah.
because I'm assuming that the price earnings ratio is stuck at 10. Now, that's very unlikely if we're in a bull market for gold. It's likely
Yeah.
the price earnings ratio to go to 25 maybe. So I put
Yeah.
25 in here as a price earnings ratio, and you'll see the numbers now change. It's not 1,000%; it's 4,000%. You might expect on some of these.
Gold has returned about 10% since the beginning of the century. So yeah, the only difference is you don't get interest, but it is as good as getting a compound interest. So if you put, let's say, 10,000 pounds into gold in 2002 here in the UK, at least, you have over 100,000 now in fiat currency. So yeah, you might sell one of your coins and still have gold, but you'll get a lot more fiat from it. And the thing about gold is that, yeah, it's money. That's why it doesn't pay interest. Cash also, paper money doesn't pay interest unless you lend it, of course. I mean, I still, the proportion of what I have in terms of a miner is still relatively small compared to what I have in physical gold and silver, but it's getting bigger because the miners are outperforming bullion. And I'm going to bring up a chart here, Clive, that shows that. Where is it? And this is, I think, Michael Oliver. He first talked about this with me when I interviewed him like a month or so ago. So this is the Philadelphia Gold and Silver Index
Mhm.
versus the gold price, and you can see that up until like 2008, it traded in the mid 20s, even during the bear market in gold, which is quite amazing. But recently we dropped to like, well, 10 years ago, we dropped to like 0.04. And and even this year, Clive, we were only at 0.05, and now it looks like we're breaking out. I think when I interviewed Michael Oliver, we're just trying to break out of this falling wedge, and now it's really taking off. So it's saying that the miners are starting to outperform gold. And if you look at it, we're at 0.07. We could go, 4 times. They could outperform bullion 4 times, and we'd still be here in the middle of this range. So I just thought I'd
Well,
show that.
get the gold and silver miners. I think August was the month where they started really moving up, powering
Yeah,
ahead of the gold price. I mean, what I noticed, even on the days when the gold price went down, the gold mining index,
yeah,
and as you say, Mary, it is very much the beginning, in my opinion. I've got the feeling that most people haven't even started to look at this,
yeah.
but there's this sort of tension building up, and you get the feeling they're getting ready to start going. Then everybody's going to try and run, and then there's going to be this race to buy the stocks, but nobody's selling them.
What we are witnessing today is not a typical market cycle, but the slow unwinding of a decades-long imbalance. For years, Americans benefited from artificially cheap imports, subsidized by the world's willingness to hold dollars and finance U.S. deficits. That system worked while confidence remained intact, but tariffs, mounting debt, and the erosion of fiscal credibility are accelerating the break. The same structures that once propped up the dollar are now undermining it. At the same time, the behavior of precious metals and miners is sending a clear and unmistakable signal. Gold has broken out of long consolidations, silver is pressing historic resistance, and mining stocks are showing relative strength after years of underperformance. Delivery patterns on COMX confirm that influential players are accumulating, not speculating. For individual investors, this isn't about timing the exact day of a breakout, but recognizing the larger shift that is already underway. Protecting purchasing power means acting before the crowd, not after. If you found this helpful analysis, make sure to like this video, subscribe to the channel, and share your thoughts in the comments. Your support helps us continue to bring you deep insights into the forces shaping our financial future.